Good morning, macro students. Today we are going to learn about one of the key figures in our macro economy that maintains the health of our economy and regulates banks, and that institution is known as the Federal Reserve. So I'm going to start the video with the agenda for today. I'm going to go over slides 46 to 60 in the Unit 4 macro notes that I linked in there. When you're finished watching this video, you can go back and review the slides if you'd like. I got some practice in there that you can work on. And then there's a 9 multiple choice question quiz titled Unit 4 Learning Standard for Banking and Canvas that you can take either today, Thursday, or over the weekend whenever you're ready. I'd just like you to get it done by Tuesday of next week. Keep in mind that tomorrow there is no e-learning. Tomorrow is a scheduled day off, and therefore our next class will be Tuesday of next week, and we only have 3 classes left for the semester. So I'm going to start with a couple of headlines here. These are a couple of headlines recently from the Wall Street Journal. That says Fed launches new lending facility for foreign central banks. And after Fed unleashes firepower, Washington rearms central bank. Congress, White House give Federal Reserve more power to handle economic response to the coronavirus. So I bring those two articles up because it's important to realize the power that this institution known as the Federal Reserve has. So today I'm going to give you some introductory information on the Federal Reserve, what it does, and by the time we end class next week, hopefully you'll have a better understanding of not only what the Federal Reserve does, but the very, very important role that it plays in our economy, especially today. You know, a lot of people, when there's bad economic times like what we're living in right now with the coronavirus, they turn to government to help them, whether they're running a business, a large corporation, they're an individual that's been unemployed, they turn to the government for assistance. And a lot of people, when they think about the government, they think about getting assistance from Congress and the president. But what people don't realize is that one of the key figures that props up the economy, especially during bad economic times, is the Federal Reserve, is our nation's central bank. So today you're going to learn more about what our nation's central bank does, how it creates money, and then next week we're going to talk about how it manages the economy in good and bad macroeconomic times. So let's get into the notes for today. Once these load, I'll be done in like 5 minutes. Okay? You guys are gonna have to wait a little bit. My son's video games are out here and they want to come out and play video games, but they can wait. This is more important. All right, banking. So our Federal Reserve was created around the time of our nation's birth, but was ended in 1836 by Andrew Jackson. He got into a big quarrel with the Federal Reserve during his presidency. He didn't like this idea of a central institution regulating banks and telling banks what they should and shouldn't be doing. So he got into a legal dispute with them and was able to essentially shutter and close down the Federal Reserve Bank. So the Federal Reserve Bank didn't reopen and wasn't recreated, I guess, until 1913, right before the beginning of World War I, and was created during the Progressive Era. So if you remember the Progressive Era, if you were in U.S. history or you're in it now, the Progressive Era was this era in U.S. history in which government took more of a proactive role in assisting the lives of its citizens, creating more social programs, trying to assist people in need, assist businesses. And that's one of the reasons, too, why the Federal Reserve was created during this time, because it was created not only to regulate banks, but to assist businesses to keep them from going under, going into foreclosure, and help people out that were in need. Essentially, prop up the banking industry and the business industry. So, the banking industry is this vast system of banks that exists all throughout the United States. I think everybody's aware of that. You guys could probably think of some banks right here in Woodstock that exist. All of those banks are charter members of the Federal Reserve. They bank with the Federal Reserve, and therefore they're subject to the regulations placed upon them by our central bank, our Federal Reserve. So I might be using a term known as the Fed. Anytime I say the Fed in this video or in future videos, or you hear somebody mention the Fed on the street, the Fed refers to our nation's central bank, the Federal Reserve. So the Federal Reserve has 12 regional banks, which you see here. We're in the 7th District. The 7th District's headquarters, the central bank there, is located in Chicago, right in downtown Chicago. I was actually able to take a class field trip with my AP class last semester and visit the Federal Reserve Bank in Chicago. If you're ever in Chicago downtown, it's right off the train line, right off from Ogilvy. It's free. You can visit it. They have a really cool walkthrough site that they could give you walking tours, and it really gives you a better idea, a better understanding of what the Fed does. But the Fed has a chairman who's appointed by the president. He serves a 4-year term. They have 12 regional banks, and each of these regional banks has a regional director or governor. These governors meet once a month with the chairman, and they decide what's known as monetary policy, and they decide how banks are doing and how banks can be assisted by the Federal Reserve. So let me click on. If you wanted to learn more about the Federal Reserve, the Federal Reserve has a really cool website with the Board of Governors. This website has all the information about what the Fed does. They come out with a lot of great data points about how unemployment is going, how inflation is, GDP, and there's a video here you're welcome to watch about what the Fed does and who they are. So here's some of the roles of the Fed. Their main mission is to make sure that another depression does not occur. And you might be laughing at that and thinking, all right, well, think about the time we're living in right now with COVID-19. It sure looks like we're moving towards a depression. Well, the Fed is doing everything in their power to prevent that from happening. And in Tuesday's class, the upcoming classes, we'll talk more about what the Fed is doing with the macroeconomy. Today, we're going to talk about how they regulate banks. And that's one of their main roles. They meet every 6 weeks to regulate banks and figure out what banks are doing and how much banks can lend. And the Federal Reserve has instituted a policy known as fractional reserve banking. So fractional reserve banking is essentially this. You make a deposit in a bank, that deposit is yours. That's your money that you could take out whenever you want because that's money that you own. The bank has to keep a certain percentage of that money. That percentage is known as a reserve requirement. That's essentially fractional reserve banking. Banks have to keep a certain percentage of deposits that people make. We'll talk about why this is in a second, but to help you understand fractional reserve banking, if you look at the example there at the bottom bullet point, if you were to walk into a bank and make a $100 deposit in the bank, and the bank has a 10% required reserve ratio. That means that they have to keep 10% of all deposits made by their investors. That means that the bank would have to keep $10 of your money, and now they would have $90 of your money to lend out. So why would banks want to lend that out? Well, let me ask you this question. How do banks make money? How do banks make a profit? I'll let you think about that for a second. So banks make a profit by taking your guys' money that you put into the bank and lending it out to other people. Because when they lend it out to other people, they're going to charge what's known as an interest rate. An interest rate is the price of borrowing. So let's stick with this example here. The bank has $90 of the money you gave them to lend out. They're going to take that $90 and they're going to lend it out to somebody who needs to buy a car, somebody who needs it for a credit card, a student loan, to start a business. And I know $90 isn't very much, so they're going to put it together with other people's deposits. But the point I'm trying to make here is when the bank gives people that loan for the credit card or to start the business or to buy the car, they're going to make money off that loan through an interest rate. So the only way banks can essentially make money is by lending it, which is important not only for banks, but for you guys, the consumer. Think about it. If there weren't banks, picture an economy in which there are no banks or in which banks cannot lend out money to people. That would essentially defeat the purpose of a bank, wouldn't it? Banks play such an important role in our economy because when people need money, who do they turn to? They turn to the government, they turn to banks for short term loans that can keep them afloat, whether they're running a business and they just need money to get them by for the next couple months, whether you need to buy a car and you don't have the $10,000 in your wallet to afford the car, if you want to go to college and you don't have the $50,000 to pay tuition for the 4 years, so you borrow it from the bank. Think about that. Kids wouldn't be going to school, people wouldn't be buying cars, they wouldn't be putting things on credit cards, and businesses wouldn't get started if it wasn't for banks. And who's the man behind the curtain that supports banks? It's the Federal Reserve. So it's important here that you guys not only understand what a reserve requirement is, but the purpose it plays in creating business and creating money in our economy. If the reserve requirement in our country was 100%, meaning banks have to keep 100%, that would be self-defeating. That wouldn't serve any purpose. They keep reserve requirements low, so banks have to hold a certain percentage and then can loan the rest out to make money and help people out that need it. And you might be wondering also, why do banks have to keep any percentage? Why can't banks just loan out all of that $100 that somebody put in the bank? Well, it's important that if you think about the Great Depression back in the 1930s, one of the characteristics that people remember of the Great Depression were those bank runs. People storming into banks because they thought banks were going to go bankrupt and trying to take out all their money at once. By making sure that banks have to keep a percentage of people's deposits in the bank, this protects them against a bank run. And you might be thinking, well, if the reserve requirement is only 10%, like you see here, and usually that's what it is in real life, it's around 10%, that's not enough for banks to cover everybody's money if they all come in and want it. That's true. That's very true. So let's say, hypothetically, that you guys are running Chase Bank, and all of a sudden, everybody storms into your bank, all your customers, and they all want their money out at once. And you have a reserve requirement right now of around 10%. Well, you don't have that money in your vaults to cover everybody, so you're probably freaking out. How are you going to pay all these people their money? It's their money. By law, you have to give it to them. There's two options you can pursue here. One is you can borrow money from other banks to hold you over. Another is you could borrow money from this guy, the Fed. The Fed exists to help banks out in times of need as well. Now, the Fed is going to charge you an interest rate for that. It's actually called the discount rate. The Fed keeps it really low, so it's easy for banks to borrow from them. But that's another way that you can lend money out to stay in business and to give people loans. And at the same time, if you needed money during a bank run, you phone the Fed or you phone your buddy up at another bank and they can assist you in times of need. This is a video, if you've ever seen It's a Wonderful Life with Jimmy Stewart. It's a great, great movie, very good uplifting movie. This is just a clip. He runs a building and loan company, essentially a bank, and this is an example of a bank run that occurred in the 1930s during the Great Depression. And there's some good connections right here to like reserve requirements and how banks make money and how banks don't always have your money actually in their vaults. So if you want to check it out on your own, it's right there. This is also another video you could check out on how banks create money. This would probably be better to watch after I go through the next few slides, because in this video, Clifford talks about the money multiplier and when banks loan money out, how it creates new money on down the way. Okay, so again, I'd recommend that you check this out if you're interested after we finish these next few slides of this video. All right, so if you were to complete this table, on the left-hand column, we're assuming that if somebody walks into the bank and they make a $2,000 deposit in the bank. In the second column on the left, you have a reserve requirement. Now notice that the reserve requirement is different and increases as you go on down this column from 5 down to 25%. So what I'd like you to do here, take a few minutes, pause the video, see if you could fill in the column on the right, or the two columns on the right, I should say. Figure out if somebody walks into the bank and makes a $2,000 deposit, the bank has to keep 5% of that $2,000. How much does the bank have to keep? So what you would do here is you would take 2,000 times 0.05. That would get you the money that the bank would have to hold on to, reserve requirements, and then whatever is left over would be the bank's excess reserves, money that they can loan out. So pause the video and see if you can complete this table. All right, by now, you should be able to have completed these last two columns, and you should get these numbers. I'll let you read this over. So if you took 0.05 times 2,000, the deposit, the bank would have to keep $100 of that $2,000 deposit, which means that they would have $1,900, $1,900 left over to loan out. 100 minus 2,000 is 1,900. And notice what happens to the reserves as the reserve requirement increases, and what happens to the excess loans as the reserve requirement increases. So as the reserve requirement increases from 5% to 25%, the amount that the bank has to hold on to increases, and therefore the amount that the bank can loan out decreases. So this is important to understand as well, that when the Fed increases reserve requirements, this means that there's going to be less money for banks to loan out, and therefore it's going to be harder for the everyday citizen to start up a business, to get a loan for a car, to get a loan for college, vacation, things like that. It's going to be more difficult. So when the Fed raises reserve requirements, banks are going to loan less. When the Fed lowers reserve requirements, banks are going to lend more because they have less they have to hold on to by law. So right now I want you to think. Right now we're going through one of the worst economic crises in our nation's history. I just got an update that as of today, Thursday, the number of unemployment claims over the last 6 weeks is 30 million people. That's unprecedented. So knowing that the economy needs a boost, banks need help, people need help, what do you think the reserve requirement has been doing over the last 6 to 8 weeks? Do you think the Fed has been increasing the reserve requirement or decreasing the reserve requirement? I'll let you think about that right now. So the correct answer is the Fed has been decreasing the reserve requirement. And if you want to know what that is right now, give me 1 second. It's 0. And it's listed right here. So if you're a bank that has between 0 and $17 million in people's deposits, you have to hold on to 0%, going all the way down to 0%. This is unprecedented. It mentions it right up at here. As of March 15th, the Federal Reserve cut the reserve requirement to 0, which means that banks have to hold on to $0 in your deposits. So if you were to walk into Chase Bank right now and put in $100 or $2,000 in Chase Bank could essentially lend out the entire $2,000. So the Fed has been doing this because they want banks to make loans, especially right now in a time of great economic need for people. Businesses who need money, people who need money to pay off other loans and pay bills. And you might be thinking, well, where are banks going to get that money if people want it out? That's where the Fed comes into play. The Fed will come in and borrow banks' money to keep them afloat. Okay? All right, so we touched on these questions already. See if you can correct the following statements. Pause the video. All right, so statement number one, the Fed was created to oversee individual businesses and stockbrokers. So there's something wrong with each of these. Part one would be wrong with the individual businesses and stockbrokers. The Fed was created to oversee the banking industry and the health of the economy. Number two, the Fed can influence the economy not through the supply of stocks, but through the supply of money and through reserve requirements and interest rates. The Fed regulates interest rates as well. Number three, one of the main goals of the Fed is to ensure that the U.S. trades with other countries. That is not true. The main goal of the Fed is to ensure the health of our macroeconomy and the regulation of the banking industry. So keep those in mind. And then last here, the last topic we're going to cover in this video. If you were to take that reserve requirement that we learned about in these couple of slides, you can now apply that to figure out how much new money could be created in an economy if somebody made a certain deposit in a bank and the bank had a certain reserve requirement. So I think I have an example here. And this is, we'll go back to the steps in a second. Somebody makes a $400 deposit in a bank. The bank has to hold 10% of that $400. So if you, right off the bat, you're going to find your reserve requirement, right? 10% of 400, 0.10 times 400 is $40. Banks have to hold on to $40. So the bank has $360 left over to loan out. So now if the bank lent out that $360, guys, let's say they combined it with another loan, they gave it to somebody to buy a car. That person takes the money, he buys a car with it. The dealer takes to their money that they made from the sale of the car, they put it in their bank. The bank lends that money out to somebody to buy a house. They buy the house, it goes to the seller puts that money in their bank. The bank takes that money, they loan it out to somebody to go to college. They pay the school with it, it goes in the school's bank. So you could follow this trail of money forever, guys. The point I'm trying to make is, if banks are to lend money out, it's going to lead to new money created because each time it's lent out, it goes into somebody else's bank, is coupled with another set of money, and then is lent out again. So essentially, when you put money into a bank, you're helping create new money in the economy. And here's how this works. The first part, you have to find what's known as the money multiplier. The money multiplier is a number that shows how much new money could be created in an economy. So step one is you have to find the multiplier. And the money multiplier formula is 1 divided by the required reserve ratio. So in this example, it's 1 divided by 0.10, which is 10. The reserve requirement always is the denominator. It goes on the bottom, which you see right here. Step two, you take your multiplier, which is 10, times the excess reserves that were created by the deposit. So because the bank has $360 left over of this $400 deposit, multiplier 10 times 360 means that if banks were to continue loaning this money out, this could lead to $3,600 in new money created throughout the economy. So it's kind of a cool concept that exists here, that the fact that your money could actually lead to new money being created throughout the economy. And this happens all the time. So again, to recap, step one, find your multiplier. 1 divided by the reserve requirement ratio. So in this case, let's say the reserve requirement ratio was 20%, it would be 1 divided by 0.20. Whatever you get for your multiplier, you would take and multiply by the excess reserves, and that's your new money created. Okay? Last thing I have for you. Customer makes a deposit of $200. The bank has a 10% required reserve ratio. See if you can find the amount the bank has to keep of that $200 deposit, the excess reserves that were created by the deposit, and then the maximum amount of new money that was created or could be created by the deposit. So pause the video and then check your answers, which are right here. So 10% of 200 is $20. Banks have to keep $20 of that $200 deposit. 20 minus 200 would be 180. Banks have $180 left over to lend out. Your money multiplier is 1 divided by the required reserve ratio. 1 divided by 0.10 is 10. So your money multiplier is 10 times the excess reserves created, 180, which means that this original $200 deposit could create $1,800 in new money. Okay? That is it. So at the conclusion of this video, you should know what the Federal Reserve does, their goals within the economy, what a reserve requirement is and how you can find that, how to use the reserve requirement to find a money multiplier, and how to use a money multiplier to find the maximum amount of new money that was created. So that's all I got. Again, feel free to check out this video too if you're looking for a little more assistance. And whenever you feel confident, you can take that quiz that is located in Canvas. Have a good rest of the day, have a good weekend, and I will talk to you all soon. Email me with questions. Later.